Do you have maxing out your TFSA in 2025 as a financial goal? If that is you, then this video is for you. Let's talk everything about the TFSA, that is the tax-free savings account, and what you can do to actually make sure that by the end of the tax year, which is next year, February, end of Feb, you have maxed it out. Hi guys, how's it going? It's Adam checking and welcome back to my YouTube channel. Like I say, let's talk about the things that you can do to make sure that you're going to max out your TFSA. If you didn't know, I am big on TFSA because if the government has actually put tools in place where we can pay less taxes, then why are we not taking up that opportunity? The TFSA is there to make sure that we are exempt from some of the taxes. For example, your dividends tax, your capital gains tax, and your income tax. If you are an investor, these are the three taxes that affect you for as long as you stay invested. Now, if you are going to earn your dividends in a TFSA, if you're going to earn interest income in a TFSA, your capital gains, they are not going to be taxed because you have them. You have your investments and your savings in a TFSA. And before we get deep into the video, please note that none of my videos constitute as financial advice. If you are looking for financial advice, please make sure that you speak to somebody who is registered with the FSCA. So the first thing that you have to do actually is to know your limits. You cannot just invest as much money as you want in your TFSA. We do have limits. The annual contribution is 36,000, meaning that you cannot invest or save more than that in one tax year. Remember, you have from the beginning of March until the end of Feb. So if you actually invest more than that, you're going to be taxed, and you can be taxed up to 40%. So you need to be mindful of the limits that are there. And the other mistake that people make is to think that the 36,000 applies to maybe the TFSA in easy equities, TFSA with your FNB, TFSA with a franc. It does not work like that. They look at the total contributions that you have made in all your TFSAs. Like I say that we do have different institutions that offer the TFSA. So if you have multiple TFSAs with these institutions, then you have to make sure that your contributions, the total contributions, do not exceed 36,000 because then you are going to be penalized. And if we look at this example, if you have invested 40,000 and the limit being 36,000, meaning that you have invested more by 4,000, that 4,000 is going to be taxed at 40%. Therefore, Uncle SARS is going to take 1.6 because you were not within the limits. So that is very much important that you need to be aware of the limits. And also another limit is that in a lifetime you cannot have more than 500,000 invested. And the second thing you can do is to invest and save consistently. If you have maxing out your TFSA as a financial goal, then you need to do everything in your power to make sure that you are going to max it out. You cannot make a mistake of not being intentional about it if you have it as a goal. And I think everybody actually should be prioritizing to max out their TFSA, because if we now have an opportunity to not pay taxes, then why are we not taking it? So I would say consider saving and investing in a TFSA consistently. That is going to help you. And also, if you get any extra income, take it, put it into the TFSA. If you are going to get a bonus, let it go to your TFSA. And actually, I think the TFSA should come before any other investment, because it doesn't make sense to me to prioritize other investments where I'm going to get taxed. And if I now look at the amount of money that I'm going to be taxed on and consider that if I was saving that money and putting it back into my investments, that can actually compound to quite a significant amount in the coming years. So I prioritize the TFSA more than anything. And if you invest on easy equities, you do know that we have ETFs under the easy equities ZAR account and also ETFs under the TFSA. I have most of my ETFs in the TFSA, and I prioritize the ones that are in the TFSA because I do understand that I need to save on taxes. And if you think we are not being taxed a lot, trust me, we get taxed a lot. For example, dividends tax is at 20%. And this does not matter if you have sold your shares or you did not. For as long as you receive dividends, you're going to pay 20% to SARS. And like I say all the time that there is no small money. If you receive 100 rands in dividends and then you give SARS 20 rands, you might feel like it's not a lot now simply because you are receiving 100 rands. Imagine if you were going to stay invested for 20 years. In the coming 20 years, your investments could amount to a whole lot of money. Now imagine if you were going to receive 20,000 in dividends and having to give SARS 20% of that. And one thing about easy equities is that they don't even come and ask you if you're going to pay SARS or not. They pay SARS on your behalf. So I think it's going to pain you so much knowing that you are taking so much of your money and giving it to SARS. So what I do actually is to prioritize my investments in the TFSA because I do understand that I am saving on taxes. And understanding the tax benefits that we actually get, that should be a motivating factor for you to stay consistent in making sure that you're going to max out your TFSA. And the third thing you can do is to use growth-oriented investments. Remember, we have dividends and then you also have capital gains. When we talk about growth, we're talking about capital gains. For you to accelerate your wealth, you need to invest in growth-oriented investments. Now, in the TFSA, on easy equities, I don't know about other platforms, so I won't talk about easy equities. We do have ETFs that focuses on growth. These are ETFs that are saying, in a year, I can grow your money by 10%, by 20%, right? And they do not focus on dividends. Yes, dividends are nice, but dividends are not going to grow your money as fast as growth can do that. So when you put your money in growth-oriented investments, then you are accelerating those interest, those capital gains. And what I like also about easy equities is that in the TFSA, you only find ETFs, right? With ETFs, you don't have to do so much of research that you would have to do if you're going to invest in individual companies. And also, if you want to also go into individual companies, you can choose to go for growth focused companies that can grow your money by even 50%. I kid you not. There are those companies that in the past year, they have yielded more than even that, right? So it's all about going out there and looking at what you can invest in that can give you so much in return. Remember, the goal is to maximize returns, right? The goal is to not just invest in the TFSA, save in the TFSA, and you are happy that, okay, you have saved 36,000 at the end of the tax year. But with how much did your 36,000 grow by? How much in dividends did you receive? That is the question, because you are actually just putting your money out there, and if it's not growing actually at the rate of inflation, then it is losing value. Let's not allow for our money to lose value if we know for a fact that we can put money into investments that can grow that money. And the fourth thing you can do is to think long term, right? You need to be okay with leaving your money for 5 years and even more than that. So the money that you're going to put into your TFSA must not be the money that you're going to need in the coming 6 months or even a year. Because when we leave our money in our investments, actually, we get the most in returns. We allow for time actually to grow our money. So if all you do is put money in the TFSA and then you take it out when you need it, you actually treat your TFSA as your emergency fund. That is the biggest mistake that you can make. Don't do that. Because what happens is you are eating into your lifetime limit. Remember, we have a lifetime limit of 500,000. So when you keep on withdrawing, you are reducing that lifetime limit that you have. And if you have 36,000 annual limit and you invest it and then you take out 6,000, for a mere fact that you have maxed it out, you cannot go back and put in that 6,000 again simply because you have withdrawn it. That's not how it works. If you have maxed it out and then you take that money out again, you cannot go back and invest again, because if you do, you're now exceeding the 36,000 limit, then you're going to be taxed. So I'd say avoid using the TFSA for short-term purposes. Don't treat it as an emergency fund, right? What we need to do is the returns that we get, we need to allow them to compound for years. And you know that in the coming 5 or 10 years, actually, your money could have multiplied. And the fifth thing you need to consider is to look into investing your money in low-cost platforms. We need to avoid going for platforms that have high fees, because these fees that we are being charged, they eat into our investments. If now let's say the platform is saying that you're going to have to pay us 1% in annual fee, then that has to come off your investments. If you have 1,000 rands invested, then they're going to take that 1% from that 1,000. So we need to prioritize investing in low-cost platforms. That is very much important. Remember, we are trying to keep as much money and also make the most in returns. So imagine if you make a return of 10% and the company comes and say, oh, I need 2% of that. That has reduced your return, right? So we need to focus on platforms that charge us the lowest fees as possible. And the last thing is to reinvest your dividends. This is very much important. The only way in which you're going to take advantage of compound interest with dividends is if you reinvest your dividends. That allows you to increase the value of your investment, buy more shares, and that is going to increase your next dividends. Remember, if you receive 100 rands in dividends and you have 1,000 rands invested, now when you reinvest that 1,000, you're now going to have 1.1 in capital. That 1,000 is the money that you did not work for. That is the passive income that you have earned, right? So you take it and you reinvest it back into the business to buy more shares and increase your capital, to increase your initial investment. That allows for the next dividend to be more. That also allows for the capital gains to be more, because if your investment is going to grow by 10%, it is no longer 10% on the 1,000, but 10% on the 1.1 that the 1,000 have increased by that 100 rands from the dividends. So do consider to reinvest your dividends. And it's very much important that you understand that you need to reinvest for a long time, right? Because you are trying to take advantage of compound interest. You cannot eat your dividends all the time. You cannot withdraw dividends all the time. You are actually defeating the whole purpose of why we need to reinvest our dividends. And what I like about these platforms is that you don't even need to do it manually, right? We do have options that you can choose whether to reinvest back into the business automatically or have it paid into your account. So if you choose to have your dividends reinvested automatically, then you have no worries, because you know that you can receive a dividend. You don't even have to go and check if the dividend came in or not, because you know that immediately you receive them, the system, the platform will reinvest automatically. So that saves you time actually. So you need to have that on and make sure that your dividends reinvest automatically. And those are the 6 things you can do to make sure that you're going to mix up your TFSA in this tax year. Remember, nothing beats an intention. And if you have a goal and you have intention, trust me, you're going to achieve it. So prioritize it, and make sure that you stay consistent with contributing towards your TFSA. And with that being said, thank you so much for watching. I will see you in my next video. Bye.